Meta Platforms and Alphabet are two of the largest tech stocks in the world, and investors are asking me which one I think is the better stock to buy at current market prices. I'm going to answer that question in this video here, so let's jump right into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. One of the first things I like to look at when comparing two companies is their revenue growth. And with these two, they've demonstrated excellent growth over the previous decade, with Meta Platforms increasing its revenue from $27.6 billion all the way up to $179 billion. That's good for a compounded annual growth rate of close to 25% in that time. Meanwhile, Alphabet has increased its revenue from $90 billion up to $371 billion. That's good for a compounded annual growth rate of 18%, but on a larger scale since it started with more than 3 times the revenue of Meta Platforms. What impresses me most about these two companies and their revenue growth is that they're generating this revenue over $175 billion for Meta and over $370 billion for Alphabet over the trailing 12-month periods, on mostly free products and services. That's what truly impresses me, that they're able to deliver free products, and there is no better customer value than free, and they're able to deliver a good product while at the same time generating sustainable unit economics, which I'll talk about next. So it's very, very easy to deliver a great customer value proposition if you're willing to ignore unit economics and you're just focused on growing your business, increasing sales. It's easy to do that. You just make a great product and you sell it for a very, very low price, a price that even causes your company to lose billions of dollars on the bottom line, as we see with some companies right now that are generating billions in losses while focusing primarily on growing the business. But what's more impressive about Alphabet and Meta is they're generating significant profit margins while also delivering mostly free products and services. That's what makes these businesses great, is that they're able to generate excellent profit margins while also delivering free products and services. It's really impressive how they've been able to do this. So Alphabet's operating cash flow to sales ratio has been volatile over the previous decade, but has maintained above the lowest it's gone is 32%. It's gone as high as 40% at one point. But over the previous decade, it's pretty much averaged around 35% OCF to sales ratio, which is a solid number. But Meta Platforms has done even better. Its ratio has also been volatile. It was on a downward trend from 2015 to 22. But remember, Meta Platforms was one of the companies among many tech companies that slashed tens of thousands of jobs when the central bank started increasing interest rates in that time to fight inflation. And investors were concerned, and enterprises were concerned, that the U.S. economy and the worldwide economy, for that matter, would slow down significantly, perhaps even going into recession in several parts of the world, and most notably the United States. And so those thousands of job cuts has resulted in meaningfully improved profitability for many tech companies, Meta Platforms included, its OCF to sales rising from 43 to 57%. However, Meta has gone on a spending spree, Alphabet as well, investing in artificial intelligence, building these data centers optimized for AI, and these investments will bear fruit in years in the future, but the initial outlay will be negative to these companies' free cash flow. So talking about those large investments in artificial intelligence, it's encouraging to see that Meta and Alphabet have been great capital allocators over the previous decade and more. Meta's return on invested capital has been volatile, fluctuating from 45% to 21%, but averaging about 34% in that time. Meanwhile, Alphabet's return on invested capital also volatile, but averaging around 25 to 27% in that time, ending at above 30% for Alphabet and over 34%, closer to 35% for Meta Platforms. When you're evaluating a company that's undertaking large capital expenditures, as Meta and Alphabet are doing right now with these data centers optimized for AI, they're spending hundreds of billions of dollars over several years in this technology. You want to take a look at the history of these companies' returns on invested capital to understand if these management teams are effective capital allocators. And the answer to that question for Meta and Alphabet is yes. These management teams have been very effective capital allocators, so you can be reasonably confident that these investments in AI are going to return sufficient returns on investment to justify that spending. So these are not free spending management teams that overspend on several initiatives and then come back to investors and apologize for overinvesting for things that didn't work out. That's not the case with these two. They've invested significantly and they've returned great results to investors. That's giving investors confidence that they can continue. And these investments in AI, there's a reason behind it that these management teams feel so strongly for investing in this technology. So now let's look at valuation. So using my proprietary discounted cash flow valuation model, which I just updated today, Alphabet's intrinsic value per share is $312. Meanwhile, the current market price is $246. So I see Alphabet stock as being undervalued right now, and it's a Hall of Fame business. So this kind of business, I would feel grateful to be able to buy at a fair value, but I can buy Alphabet stock right now at an undervaluation, which is an attractive opportunity for investors. Similarly, with Meta Platforms, I calculated its intrinsic value at $857. The current market price is $714. Meta Platforms also ranks up there in the Hall of Fame category of businesses. I would be grateful to be able to have the opportunity to buy this stock at a fair value, but we can all buy this stock at an undervaluation right now. Again, a great opportunity for investors at the moment. Now, when I go back to fiscal.ai, which is where I've been getting all these charts, there's a link in the description if you're interested. The valuation on a forward price to earnings basis is nearly identical. So they're both trading at a forward PE of around 25, which I also think is an undervaluation given these companies' revenue growth rates, the excellent customer value proposition, the great unit economics, the massive total addressable market opportunity in advertising and artificial intelligence. I think these two are excellent at current market prices. I have them both rated as a buy, actually. So I like both of these companies. And if I had to pick between these two, it would be a close call. This wouldn't be an easy decision. Uh, Meta Platforms has made great progress, and Alphabet in recent weeks has the valuation has increased meaningfully. The share price has gone up, and the valuation has increased meaningfully. So it's a really close call between these two right now. And if I had to pick one, I would pick Alphabet, but it would only be slightly better than Meta Platforms. It's really close. They're both excellent companies. And guess what? No one is forcing you to pick only one of them. You're perfectly allowed to pick each of these two. Take your, let's say, if you're thinking about investing $1,000 and trying to pick one of them, you can just do 500 and 500 and thereby having allocation to both of these excellent tech stocks. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.